Hello traders, Gary Wagner here, just about 10:45 in Honolulu, 4:45 in New York. It's Thursday, 8th day of October 2015, and this is Trending Markets. We had a dynamic move in the U.S. equities markets. Dow Jones Industrial Average closing up about 138 points on the day to close above 17,000 for the first time since we have seen this market go into corrective mode back towards the end of August. Now, we had roughly a 0.75% move in the Dow Jones Industrial Average. That also corresponded to a likewise move in the Standard & Poor's. Standard & Poor's trading up 0.88% to close over 2,000 at 2,005 is currently where it's at, up 17.75 points. Now, we did put out a trade recommendation on the 6th, Tuesday at the close of markets, to begin to initiate or pick up long positions in both crude oil as well as the Standard & Poor's. We're working with the E-mini here. Traders that took that call got long roughly at 1968. We've seen this market move considerably from that point. And if you recall from that session, we talked about the fact that if we have this market close above 2,000, that's when we're going to look to put the second leg or an additional long position on to this current trade. We'll talk about that in a little bit. We also sent out a recommendation to trail our stops up. Stops should now be sitting at 1986, just under there. We'll look at a chart that really defines why we put the stop at that particular price point. And traders, when we sent out our special trade alert this morning, we also mentioned that if you've not done so already, enter the S&P 500 from the long side and crude oil from the long side. Traders that got in today got in roughly at 1986, 1987. We initially had a stop at 40, and that stop at 40 was for the initial position that we put on at 68. We then trailed that up later in the day and actually moved that to just under 1986. So traders, before we look at our upside targets and what our exit strategy is, I do want to define why we trailed our stop up and why we trailed it up to this particular price point of roughly 1986. The primary reason was I wanted to put our stop underneath the point in which we have, or should now at this point, have some really good support. You see these tops here, these tops here. This is really where the market took off, and when it broke above this particular price point, this is a very, very short-term chart, 15 minutes, but you can see that it really spiked higher. Of course, minutes being released from the latest FOMC meeting sparked a lot of this activity in U.S. equities, because the current take or read on actions by upcoming Federal Reserve meetings will be to not raise interest rates, to not initiate liftoff, as they call it. It's expected now that we will probably not see rate hikes through the end of this year and probably into the first quarter of next year. So traders, I want to go over our exit strategy, our upside target, and the rationale or reason that I spoke about putting this particular trade on in legs, and that we would put one position on when we initiated it at 68. And I am going to recommend that we add to that position on effective closes in the S&P over 2,000, which we certainly got today with the market trading at 2,005 currently. Now, the reason for this was quite simple. I have two basic moving averages here. Short-term moving average is a 50-day moving average, and of course, the one that longer term traders follow, which is our 200-day moving average, and that is in blue. There's a couple of things that are very, very clear to me, and that is when we consider the most recent top, that was this shooting star here. We are looking at a daily chart, and the fact that at this point we would cross over that shorter term or 50-day moving average tells me that if we can effectively see this market form a base and support now in this area, meaning 2,000 now becomes support. Our next real target is anywhere between, call it 2050 and 2075, which would put us, of course, up in the area close to that 200-day moving average. Now, my recommendation is we hold the current position that we have. We've raised our stops, hold the current stop that we have until we get a clear indication that we are going to see this particular price point, 2,000, become support rather than former resistance. So traders, to summarize, maintain current long positions for those that got in at 1967, or for those that took the call today and got in at roughly 1986. All stops at this point should be moved just under 1986, locking in good profits for traders that took that call on Tuesday, and very, very decent profits for those who initiated the trade today. Again, as I talked about in terms of an upside target, we are looking to add positions because we have effectively broke and closed above this 2,000 point, but I do want to see a base form and support at this level. My initial target, as I said, is going to be roughly 2050, and that is a 23% retracement of the actual corrective period we had when the market was up at around 2120 to the most recent lows that we saw after the market fell. So traders, lastly, I do want to speak about our other trade that we put on Tuesday as well as today, which was to initiate long positions in crude oil. There were a couple of factors that we talked about, if you recall. One of the primary factors that we looked at was the fact that when we saw the characteristics of the way this market hit this double bottom here and traded higher, it was really followed by a fairly protracted period of consolidation. These are weekly candles, but if you look at the relationship between the open and close, that's the real body, it roughly closed at the same price point on Friday that it opened on Monday at, and that was just preceding this secondary dip back to these lower lows at around 37. My sense was that we were witnessing this consolidation again, and we were going to look to see how this market broke. My belief was we would see a break to the upside, but most importantly, what I had mentioned is as we were in this compression triangle, we would see it break one way or the other, which we absolutely have. Let's go ahead and kind of rescale this, but we would see this really break one way or the other. And we certainly saw this market have a dynamic breakout to the upside. Now, we initially got into this market at 48.47. In fact, we took the call during this particular day. This is Tuesday during the rise, and we got in really a little bit closer to the top than the bottom. Right here is 48.28, 51, and as I said, we got in at around 47. So right here on the close, the following day, meaning yesterday, we had a little bit of pressure. I wasn't that concerned. We had a little bit of backfill. That's this red candle. And of course, today, we had the market break dynamically, actually testing $50 per barrel. Now, initially, we had a stop, which was at 45.63, and that was really based upon the low that we saw of this large green move. In other words, the breakout candle itself, we put it at the low. We also sent out a trade alert recommending that you trail stop, so all traders should now have your stop just below 47, which would put it right at this particular price point. And my recommendation is to maintain our current long crude oil position, maintain our current stop just below 47. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another Trending Markets and have our weekend review. Bye-bye.